So we'll just kind of start off. How do we learn? How do we improve the skill of trading in that sense? So when we're learning a skill, it's important to kind of know the foundation of that, the meta skills. So learning how to learn. So trading is very similar to any other skill. Can be riding a bike, shooting a basketball hoop. It's probably most similar to poker, because that's also a game of probabilities. So if you want to get better at shooting a hoop, you can read a book, watch a YouTube video on how to shoot that hoop, but it's still kind of limited. You might know certain techniques or pointers to improve, but you're going to get the most benefit out of practice. Doing that skill, executing on that skill over and over again, getting that experience, bit of that intuition, that kinesthetic sense on how to improve that skill. That implicit knowledge is a lot more valuable than the explicit. So that can be drawn over to trading. We spend a lot of our time reading books, watching YouTube videos, a lot more than actually trading itself. So if you want to improve the most or understand price action, you just have to look at charts and take trades. So the basic way to improve it. But how do we kind of make the most out of that endeavor? So it's good to take trades, but how do we actually learn from that? In the learning process, in progression, it starts off like any other skill. You have the input. So I might shoot a hoop, I might take a trade, it gets processed, I make it, my shot goes in, I win a trade or it misses and I lose a trade. That's feedback. So in basketball, that's immediate feedback, but the critical difference here from trading to any other skill is that your output are disconnected because it's a game of probabilities. You can take the perfect shot in basketball and it can go in every time, but if you take the perfect trade, it might lose. It might lose multiple times. It might suit all your rules. You might take it and it will lose. So that's giving you a negative output from a positive input. That's kind of messing with your feedback. So how do we kind of get around that? Well, we need enough data points to draw a correlation, a conclusion from. So trade by trade, it is enough information to have feedback to draw a conclusion, but 20, 30, 50, 100. The more trades, the better. You have more data points. It's easier to draw a smoother line in which inputs lead to better outputs. And the way to get that is by having a journal. So if you don't have a journal and you're just taking it trade by trade, most likely you're just going to be going in circles because you might change something because you're getting certain negative outputs, but you might have changed something for the negative, even though you're having positive inputs, making positive trades, but it's leading to bad results just because it's a random series distribution of wins and losses. So you need enough data points to draw an accurate conclusion from. That's where a journal comes in. It's the easiest tool. It can be the most objective because a lot of trading is subjective, discretion, intuition as manual traders. This is how you build a strategy. This is how no strategy will ever make you profitable, but you can make any strategy profitable through enough experience, intuition, and practice. Enough data collected, you can find easy ways to improve a system. So if we go back to this loop, when you have that feedback, you can then review that, learn, and improve. So this is implicit knowledge, implicit learning. The most valuable information you'll ever find will be something that you've written down in your journal. Because if you want to change for the better, the foundation of all change is awareness. First and foremost, you have to be aware of a problem to be able to change it and fix it. And a journal doesn't have to be my one, but a journal will help you give that awareness, gain that awareness, and allow you to improve. A clear example of improvement, I've taken 275 trades, 56% win rate. When I first started this journal, the first 20, 30 trades was probably around 40%, 45%, but it improved over time through iteration upon iteration. I kept on iterating, improving my inputs. Maybe they lead to better outputs. Maybe they lead to worse outputs. There's still feedback information to then improve and learn. So these little black dots are my latest iteration. If I go back further in the journal, these icons are a bit different. And you might see that I lost a bit more as well. I was less profitable. I revamped, I had a look at all my data, and then I made changes for the better. A pretty clear indication is that I have a 56% win rate over 275 journal trades. If I just look for a clear 1 minute shift in low time frame, I'll go over that a bit later. That 56% win rate jumps up to 74% win rate over 77 trades. Now, you might trade this way and might decrease your win rate because it doesn't work for you. Trading is all about finding your niche, what you're good at, and what suits your psychology. For some reason, this certain setup suits me really well, and it increases my win rate by almost 20%, which is crazy. So that's an easy way to improve my system and make maybe a break-even, unprofitable strategy profitable. But yeah, so a journal is all about tracking that, getting that feedback, tracking that plan. But you have to track that feedback against a certain goal. I'm trying to improve a skill. How do I know what I need to do? A journal will help with that, but you need to have a plan. In order to be consistently profitable, you first need to be consistent. So you need to have a plan. But as we go back to, no strategy will be profitable over the long run. So instead of having a mechanical plan, you need some discretion, some intuition. This is rule based. This is more gut feeling, intuition. I go for a mix. So I'm consistently executing on my intuition. I've journaled and identified what my intuition is best at. And this helps massively with that. Makes it so much easier. You can find what things you should look for. So a plan is just to point you in the right direction, to kind of know what you need to do. A journal is to track the execution, track how you're executing on that plan, and also track how that plan's going in certain conditions, certain types of trades. If you do that for a certain amount of time, you'll know what you need to do. Then it'll be all about closing that gap between knowing and doing. So this is where psychology comes in. If you don't know what you need to do, if you don't have a plan, if you're not journaling, psychology isn't your issue because you don't have an edge. You're just taking random trades just off intuition. You don't know if that intuition is correct. So that's kind of where those two come in. Yeah. So we'll go into how do we find a plan? How do we find an approach? How do we track that approach to actually kind of find some consistent profitability? So trading is a relatively complicated skill. So I like to keep it simple. My approach is price action. So how do candles move? Market structure, all that sort of stuff. All this works. Every strategy works. It's just about pattern recognition and finding what works for you. Some of the best traders traded in an EMA bounce. There's no statistical edge in an EMA bounce, but it worked for them because they had enough experience. Another person, a really famous trader, drew a box around price when it was consolidating. When it broke out of that price, he would then take a trade. There's no edge in that, but he had that much experience that his intuition made it profitable. So technical analysis is a way to have a consistent approach, have a plan that we can stick to. But technical analysis, we focus on it most of the time, but it's only the peak of the pyramid. This is the easy part. Technical analysis is the easy part. Risk management is the boring part. Psychology is the hard part. But we need to have a consistent approach before we can kind of worry about these things. So this technique won't make you profitable, but it's a tool that you kind of need to give you a chance. So I try to keep my trading simple, as I said. So simple 3-step process. You kind of find this in any system. But overall, I just look for a overall high time frame, shorter time frame, just a sense of direction. Where is price moving over the next hour, the next day, or the next 10 minutes? Just an overall direction. But this is actually quite difficult. It's subjective, it's not clear always, and it's different on different time frames. So price is fractal, important concept. What happens on the larger time frames, it happens on the smaller time frames. So maybe we're bearish, maybe we're bullish, maybe we're kind of just ranging. That's still a direction, it's just sideways. So adapting to changing market conditions is kind of the hard part, but you need to do it to be consistently profitable. You might be profitable for periods of time, mainly That's due to you either not having a consistent approach or being unable to adapt to changing conditions because your approach is too rules based and of flexibility. So those two things, and they're opposites. So not consistent enough, too intuitive, too rules based, not flexible enough. So you're trying to find the sweet spot for you in the middle. So going back to that direction, bullish, bearish, we'll go over how we find that. And price doesn't move straight in one direction. It's kind of a push and pull, like an elastic band. There's always going to be a bit of tension when we push or pull, but yeah. The second step is just an area of interest or a level. That can be basic support and resistance, which is what I use. Or if you want to be a bit fancy, you can do smart money concepts such as order blocks, fair value gaps. Just find what works for you and you can consistently trade. It doesn't really matter. Just find what works for you. And I'll go through how I find that as well. Step 3 is just an entry model. There's lots of different entry models. I've used tons of different ones. I found for me, this is the most consistent. When I said my win rate increased from 56% to 74%, it's because of mainly this entry model. So we're making higher highs, high lows. We make a high, then we immediately break a low. Have a shift in structure. That's for sells. Enter, stop above the high, maybe target some lows. For buys, it's the inverse. So that shift. Reason I look for this is because I used to enter trades early and get stopped out a lot. So waiting for this shift signifies to me a clear lower time frame change in direction. So volume comes in, we just made a high, and then immediately made a low. This is a pretty clear shift in direction, pretty clear push. And always wait for the pullback, just because most of the time it does, but this also presents an opportunity to manage our trade, which we can go over later. But that's the 3-step process. It allows me to be consistent, but it's also adaptable enough to changing conditions. It works in consolidation, it works in trend days. You're going to find this through most conditions. If it's too much volume, sometimes you just won't get that pullback, it'll just go. Or if it's too rangy, you just won't get that clear shift, and that's fine. Not all approach works, but how do I kind of find my direction and area of interest? So 2 main concepts I use. And keep in mind, this is all fractal. It all happens on every time frame at the same time. So it's a bit hard to keep that in mind. So first thing I look at is candle behavior. How do candles form throughout the life cycle of a candle? It could be the daily, the hourly, or the minute. The second thing I look at is market structure. So higher highs, higher lows. If you're ranging, bearish, if you're kind of pretty volatile, different conditions, and we can go over that as well. But these 2 things is what I look at with candle behavior. So this can be more if we're moving bullish, extremely bullish. We have been the last, well, at the beginning of this month, we've been moving extremely bullish on gold, breaking all-time highs. Let's say this is the daily candle. If the daily opens up, and I'm expecting us to continue bullish, very bullish, price doesn't move in one direction. So most likely, I find in the first half of that candle, we're going to create a bottom wick, grab liquidity, anything like that, just to then, so maybe create that bottom wick in Asia, then reverse in London, push in late to London, New York, to then flip and continue that bullish trend. And this might look like for market structure on lower time frame. Maybe this is the hourly on the daily candle. So hourly, higher highs and higher lows. So these 2 interact or are used in conjunction with each other. But then why do I look for candle behavior if I can just look at market structure? It's because candle behavior makes it easy to give timing to market structure. When am I supposed to look for this pullback? An easy way is that if the daily time frame is looking extremely bullish, I can look for that pullback most likely around the start of Asia. We can go through some examples on gold. So on the hourly, that might be the first 30 minutes, the first 15, 5 minutes. On the 1 minute, it might be the first 30 seconds that we pull back to then continue. Price needs to grab volume to move. It's a constant push and pull. And candle behavior gives timing to that. And remember, this is all fractal. So different candles open at different times, like being aware of the 4 hour, the hourly, when the daily, when the 30-minute candle opens and closes. It's all fractal and will affect how price moves. And I'm not looking for certain things. I'm looking to stack timeframes, stack all these confluences, variables. I want them to align in my favor. So this is a lot of information. It's going to be hard to memorize this. So when you first start out learning a certain approach, a skill, if you're going to learn this certain approach, it's good to have more rigid rules, rigid adherence to rules, less discretionary judgment. But in order to kind of improve, you're going to have to gain that awareness, gain that perception through that journal, that plan, tracking. And then when you become an expert, you transcend that reliance, less rule-based, more intuitive grasp. And you've been able to validate your intuition because it's a feeling. In trading, we don't want to be robots. We need our feelings to be profitable. A lot of people think that's what makes them unprofitable is their feelings, but you need it. Brains are amazing at pattern recognition, our subconscious. So rely on that gut feeling, but validate it first through a journal. And that's the approach that I use, that sort of stuff. And that's consistent. It's consistent, but it's also adaptable. It's subjective. There's flexibility in that. We'll go through direction first. What are some examples of clear direction? We'll go on the daily first. So gold has been breaking all-time highs. We've been extremely directional. That's pretty clear directional right there. So if we open on the daily, creating that bottom wick, maybe in Asia, to then continue bullish. This is where adapting to changing conditions comes in. The way I trade this will be different from this. This is more indecisive, more range bound. This is a bit more indecisive, kind of a bit more clear directional. This is more higher volume range. It's all about adapting, and that comes from experience. But you can still use the same sort of daily concepts, session cycles, monthly, daily, hourly, on all time frames or conditions. You just have to adapt. So we'll go through some examples. The daily candle opens just before Tokyo Open. So this is likely to happen. It's not a rule. It's not always going to happen, but it's characteristic based. We're looking for probabilities, not certainties. There's no certainty in the market, so it's just probabilities. So the daily candle opens, we create that top wick, we go create that bottom wick late in Asia. So it doesn't really work out that well in that example. But in this one, daily candle opens, in the first half of Asia, we create that bottom wick, then we reverse in London, push in New York. Same here, first half of the day, create that bottom wick, push a bit in Asia, push more in London and New York. Same here, open, create that low, push. Again, open, create that low, push. Open, create that low, and push. So if you were to adapt to these conditions, you'd be able to trade that really well. But then, when you start to enter more range bound, you'd need to use a different process. You can still use certain these characteristics of candle behavior, creating that bottom wick in the first half of Asia if we're looking bullish. Even though this is range bound, we'll just actually go over that as well. Because on Thursday, on Thursday, it was a really nice opportunity to trade that daily bias, that daily direction, especially on Asia, in kind of more range bound. This is less clear in these conditions, but let's say here, okay, on gold, I trade Asia, the second half of Asia, but this daily candle closes bullish, so likely we're still looking on the daily candle or on the daily time frame pretty bullish. So maybe we'll create that bottom wick to then continue, or if I look on the 4 hourly, kind of broke these lows here. Maybe that's a shift in structure. What it normally look like for an entry model. Maybe that's a shift. So maybe we'll still create that bottom wick, but maybe we'll actually reverse and we won't flip. But those are two opportunities. I'm stacking probabilities that likely this is going to be bearish. So daily and 4 hour is kind of showing me it to be a little bit more bearish, especially at the start of Asia. Now, where am I kind of looking to take a trade from? An area of interest, zones, levels, basic support and resistance. Step 2 is I just draw zones at lows, highs. Where has price reacted to? I'll just put zones there. levels are a bit more clear. It's just at the open and the close of price when we go from bullish to bearish to body. So on the hourly, exactly the same. This is fractal. This way of finding levels can be used for all time frames. So there's just pretty clear levels, zones. Maybe I can look for a reaction here. So I'll wait for Asia session to open, Tokyo open. So Tokyo opens, and keeping in mind, remember daily, this was a bullish candle close. So I'm looking forward to create that bottom wick at least. But 4-hour structure is looking like it's going to be a bit bearish to reverse because we broke these previous lows here after making it higher. So I'm just kind of looking for a reaction to this zone with my short-term bearish direction. So we've come in, made higher highs, made a high, broken a low. So this is a type 3, that shift on the 15-minute. I can wait for a pullback into maybe this previous hourly level to then take a sell and take that. Maybe I don't want to enter on this time frame. I always enter on the 1 minute. I wait for that 1 minute shift because I kind of like to have a small stop loss and enter with the low time frame volume. So even though this is like a high time frame, 15-minute type 3, I can wait for maybe a small time frame one here. Price is fractal. What happens on larger time frames happens on small time frames. And you'll even see on the inverse here, on the reversal, that we have that we just barely break that low, and then we break these highs, test those highs, and come back into that. So I just find this tends to happen in price action. So you can take a sell here, maybe put your stop loss above here, maybe the previous high will be high probability, or what I'll do is wait for low time frame structure, 1 minute, to have that shift. So we have that high, low, then we can consolidate, and then we break that low. So it's kind of what it looks like. So it always look a bit different. Sometimes it might look like this, or maybe you get it really clean like that. It's flexible in approach. It's not rule-based per se, but I have that clear shift. We have these kind of low time frame lows here. Exactly the same way I find a zone on the high time frame. I look for it there. So I can enter, stop above the high. I can target these previous lows, or I can target a level, just loading, or I can target this hourly level here. So the hourly level I can target. So the more you target, the lower your win rate, the higher your risk to reward, and that's just probabilities. You're asking for prices to move further in one direction. So we hit that target, the hourly. That's a pretty nice trade, and that was on Thursday. This is kind of more ranging. Another reason for me looking for sells here is because we had this push up. We didn't really have a pullback here. We just pushed straight up. So maybe we left some orders behind here. Maybe we're still moving overall bullish, but likely if we move bullish, we're going to maybe have a pullback first. If we're reversing, we're having a pullback. If we're creating that daily bottom wick, we're going to have a pullback. So I'm stacking probabilities in my favor in that scenario. An example of more daily bias in trending conditions was on Friday, this Friday, on gold here. So we have this 30-minute here. We have these previous highs. Just get that here. So Tokyo Open. Short term, I have a short-term bearish bias because the daily candle opened around here. I'm expecting it to create that bottom wick. We've had this kind of push up. Maybe if we're going to continue, we're going to have that pullback. So daily bias from that, creating that bottom wick in Asia. Similar to the Thursday after that, looking for that shift. We had these higher highs and higher lows, and then we broke this low, and I can look for a comeback into these lows. I can look for into this 30-minute low that I drew here. We rejected these highs. I put this 30-minute level. Maybe we'll react to that and move bearish. So I can put an entry there. I can wait for maybe a candle close, anything like that. It depends. So we have that entry, but if I just don't want to enter there, maybe on a limit or market order, if I want some more confirmation, you see how this 1 minute candle closed? I can use the exact same way that I'm trading the daily candle for it to pull back in the first half to then continue on this 1 minute. So maybe in the first 30 seconds, we'll have like a pullback just to fill some of this body to then continue bearish, which we did. We had a pullback and then we continued. And it was a nice trade to make that daily bottom wick to then move bearish in the remainder of the day. So pretty clear shift to that. That was a really clear, clean shift. The day before that, it was less clear. It was a bit more low volume, more consolidation, but we still had that shift. We broke these highs, then immediately broke these lows. This was on Asia, around the daily candle open again to create that bottom wick in the later half of the session. We still got that shift, retested these previous lows, stop above the high, targeting structure. So the exact same thing played out multiple times in different conditions. This was more directional. A bit later, it was more range bound. And that's how I kind of analyze, do direction, area of interest, and that shift. I find it gives me a pretty good opportunity. But this is very intuitive to me. I don't have to think about it as much per se. I've internalized it. It's intuitive, and that you'll be able to do that. That will come with experience. So yeah, and so that's the approach: the direction, area of interest, the level, and the shift. The more you practice, the better you get at spotting it. But I know what I need to do. I just need to take those actions, and I can have confidence because I know it works. I don't have to have faith. There's evidence that backs it up. That if I take these trades, it'll lead to a positive outcome. And confidence is just a expectancy of a positive result from certain actions. And another thing as well, all good. Another thing I look for is just so dollar index. So because this is gold, the dollar index will be inversely correlated. So most of the time when the dollar is bullish, gold will be bearish. So it's another way to find direction. It's just to stack probabilities in my favor and all that as well. And I look at dollar the exact same way I look at gold. Counter behavior, market structure, through the lens of those two things. So that's technique. All that information is the peak. This is the easy, the fun part. It'll come just with experience. You'll get good at it. Then once you've got that kind of under, it can take a couple of months, but once you've got that under wraps, then it's just behavior. This is the hard part, the big part that most people fail at, but they don't understand that they're failing at this. I think it's this. It's not technique most of the time, it's your behavior. But you can only kind of target that behavior if you have a consistent plan that you're following. The process is the direction, area of interest, that shift. On my main account, 1% risk, max 2 trades a day, keep it consistent, and then have your rules. So risk management should be mechanical, more mechanical. You want to keep it consistent. So I'm trading my intuition. I'm focusing on my risk, not trying to make money. I'm focusing on my risk, and then I'm managing my psychology. And that's the approach. When you have that plan, you try to stick to it. You journal how that plan goes in certain conditions. You may be finding ways to improve it. Maybe finding ways for you to execute on that better. When you have those two, and you're getting that feedback, it's you're focusing on learning rather than winning. If you focus on learning, it's inevitable that you'll be profitable because if you get better 1% every day, week, month, over time, it'll be inevitable that you get to the point where you're profitable. If you focus on winning, you're just taking chances. It's an if. You can change that maybe from an inevitability if you focus on learning. And the only way you can do that is through tracking a journal and collecting that information. Because each loss you take presents an opportunity to learn. So instead of either just winning or losing when you're not tracking trades, it's a positive or negative. When you're tracking trades, it's a positive or a positive. You either win a trade, you gain money, percentage, all that good stuff, or you learn something new. You can find commonalities in your losses. So I always think of it, every loss I take will leave me closer to the next win. It's just business expenses, it's the cost of tuition. So when I have that positive outlook, I can have that confidence because it's a win-win. I win or I learn something new. I'm able to focus on that internal reward. I'm detaching myself. I'm getting that independence from the outcome. I can trade a live account, like a demo account, because I don't care if I win or lose. I'm focused on learning the skill. The money's less of an issue. That's kind of overpowered. The meta. The only holy grail in trading, the holy grail isn't going to be the technique or the strategy. It's going to be cultivating a behavior, optimizing your behavior, your mindset, all that sort of stuff. The holy grail is being competent and carefree, being in a state of flow, and being able to access your intuition without fear, without seeing the market as hostile. That's the holy grail in trading, is that emotional mindset. Because intuition is a feeling. And if you're fearful, if you're risk averse, if you're greedy, that's going to degrade your edge. So yeah, that's technical analysis, that's behavior. It's important to keep in mind, because a lot of times we look for more analysis when that's not the problem. It's because we just need to do the things that we know we need to do. It's just maybe a bit tedious. Journaling is tedious. Having a plan, it's a bit confronting. Journaling your losses is not fun. I don't like journaling my losses. It's a bit painful to the ego. I have to confront my mistakes. It's easier to push them to the side and not think about them, but you're throwing away all that valuable information, that learning. So yeah, when you journal, you understand the statistics that underlie your system a bit better. So you might know kind of what your average target is. Maybe you might not know what your win rate is. Maybe you have an idea, but you don't know the actual win rate. But this will inform how much you risk on a certain trade. If I know a setup has a 80% win rate, I can risk a lot more than if it has a 60, 50% win rate, just because it's less likely to have a period of consecutive losing trades. It's less likely to have that average max drawdown. If I have an 80% win rate in a 50 trade period, I'm likely to lose 2 trades in a row. If it's 50%, I'm likely to lose 6 trades in a row. This is the reality of trading. There's always going to be a trade-off. The more you target, the less likely you are to win. That's completely fine. But yeah, most traders have around 50-60% win rate, and that's great. That's profitable. You can have a 50% win rate with a 1.5 risk to reward, which is what I had for a long time. You just have to accept the reality that if you want to be a profitable trader, you have to be okay with going through 6 losses in a row. This is profitable trading, going through 6 losses in a row. This is the reality of it. So yeah. So if you're just making trades based off trade by trade, you don't have enough data points to make a informed decision. That kind of can degrade your edge. So maybe you were winning. So I went through that a lot of times. I made that mistake a lot, over refining, making a decision and leading to a bad outcome. So maybe you start off and you're winning quite a lot, winning more than you're losing. And then you hit this period here. Maybe you hit that. This is still profitable trading. This is you trading profitably. It's just unlucky. This is inevitably going to happen in your trading journey. What you need to do in this is it's difficult, it's hard, it's uncomfortable. Is you need to trade through this without changing anything. You can change something after you don't. Yeah. That's why you need to have keep a journal, because then you can look back at those trades as well. I have that information that I can look back on from the past year and see what I was doing right. I can focus on what I was doing right. I can go back to that. But profitable trading is being able to trade through this without changing anything, and that's difficult. That's where a lot of traders mess up. But yeah, so you have a plan. So let's say actionable steps for you. I would say it's really hard. We'll go through kind of prop firm psychology as well. But actionable steps, what would give you the biggest bang for your buck? You've been trading for a couple of years. So more trading actually won't lead to that much more improvement. Now it's about maybe less trading, more preparation. The more prepared you are, the easier it is technically and psychologically. It's not about learning, it's about having understanding now. So how do we get there? Step 1 is just to create a plan. How do you want to trade? How do you think you want to trade? Don't overthink this, because you are going to change it eventually over time. It's going to evolve. My plan changes, but it only changes when I have enough information from my journal to create an informed decision backed by some sort of evidence. A lot of the time when I'm changing a plan, you might change it because of an intuitive feel. Maybe if I change something, if I do this, I have a feeling that if I change it, it'll be better. That's how I came across that shift, that type 3. But I was able to look back at my journal and back up that decision with data. to make that profitable change with evidence, it needs to be backed by data. Those two steps, if you just focus on those two things, your trading will massively improve. You're less likely to feel that you're going in circles and more likely to feel that you're going in a certain direction. So maybe you change something and then you're going back down, or you change something, it goes for the better, and you go hitting loss period, then you change something and it messes with your edge, and then you're going circles. When you're collecting data, it's easier to go in the direction you want because you have that awareness. You're able to make better decisions. Yeah. So I've sent you my plan and my journal template as well. So the plan's for reference. There's a lot of journal trades there. There's also the template that you can fill out and journal your trades. You don't have to use my journal. You can use other software, other templates. It's just an easy thing to do. It's free. There's a lot of free options, just tracking, getting that awareness as well. And yeah, that will allow you to then clearly know what you need to do. Trading is uncertain. We're always working with limited information. We don't know what to do in certain scenarios. But when you're uncertain about your plan, you're doubling up that uncertainty. So you're making it double as hard. When you're certain about your plan, you know what you need to do. It's still going to be uncertain conditions, markets, uncertain information, but it's easier now to close that gap to do because you know what you need to do. Now it's just doing it and closing that gap. This is where psychology becomes more of an issue. And for psychology, it would be more working on our expectations, our beliefs, our thoughts. There's a couple of different tools here that we can go over as well. So with prop firms, it's a bit difficult because it's so centered around a profit target. You're trying to get to a certain way. The closer you are to a profit target, so you're 1% away, the harder it is because you're so close. So much more pressure on the outcome. Do you kind of get to those days where, let's say you're up 6% on an account, so you're 2% away. Let's say, oh, you visualize yourself, if I won a trade, if it was a 1-to-1, now I'm 1% closer, I only need to win one more trade. Or if I win a 1-to-2, I'll pass the challenge. Visualizing that, that winning outcome happening. I did the same thing. I'd visualize the outcome going from 5 to 6%. And what happens in that scenario is that you're setting an expectation. You're setting a fantasy. You're living out that fantasy on your head. So let's say if you win, nice. You reach that fantasy. You reach that expectation. But what happens if you lose? And that might be half the time. So if you lose, yes, you have that pain of that loss. So we'll say that's 1 times the pain. But because you had that expectation, that 1 times pain now turns to 2 times pain. Because you're not only losing the progress that you made on the account, you're also losing that expectation. This expectation, this fantasy is being ripped away from you. When something doesn't meet your expectations in anything in life, it feels bad. It feels worse than it actually is. Yeah. So how do we fix that? Prop firms make it notoriously difficult to pass because of that kind of psychology. They're made to fail, prop traders. So how do we get around that? It's pretty simple, actually. Instead of setting an expectation, visualizing a positive outcome, we do the opposite. Visualize the worst possible outcome, set a negative expectation that expect to lose. Might sound negative going into the day expecting to lose, but I found when I went to a day expecting to lose and being okay with that, it was so much easier to trade and it was so much easier to lose and learn from that losses because I knew a loss was just a part of the process. It's new learning. It's not a bad thing. I'm not expecting to lose. I'm not going to visualize how good it feels to be up and focus on that outcome. So how do we do that? Maybe before your trading session, maybe in the morning, sit in a quiet area, focus on your breathing. We can go through that as well. Breathing, it's hard to control them with the mind. If you want to control your mind, it starts with the body. physical control. So controlling your breathing first, because emotions present themselves as physical sensations first. If you're getting fearful, maybe your breath starts to shallow, gets quicker, your heart starts to beat quicker, you start to sweat. You might feel those sensations when you're in a trade because it's kind of fear-based. So if you want to control that, maybe it starts with controlling your breathing. So when you're sitting down in the morning, visualizing that loss, focus on controlling your breathing, being in a calm state of mind. Maybe I'm visualizing in as much detail that shift. I'm visualizing myself clicking that button to enter. I'm putting myself above that high. I'm targeting market structure in as much detail as possible. So I enter, focusing on my breathing in a calm state of mind, and then maybe price is kind of going in my direction. Maybe then it doesn't. I'm visualizing in as much detail. It's getting closer to my stop loss. Maybe it's going again. A bit of hope. And it takes me out. Takes up my stop loss. I visualize that loss. I visualize maybe that 1% on my account. Now it's down to 2% instead of 3%. How does that feel? How am I feeling? I actually don't feel that bad. The actual sensation of that, I'm calm. I'm in a calm state of mind when I went through this mental rehearsal. I've visualized that loss. I've set an expectation that if I lose, that's perfectly fine. I've stuck to my plan. I've stuck to my process. This is inevitable, and I can learn from it and improve. So by setting that negative expectation, that visualization, doing the opposite of what most traders do when they're trading a prop firm, you're able to combat that emotional response from that fantasy being ripped away from you. So just give it a try, and yeah, also having a probabilistic mindset, all that sort of stuff. Going back to behavior, that helps with your behavior. And trading is all about pain tolerance, discomfort. 90% of traders don't lose, or they lose because they can't withstand that discomfort and that pain. Doing the right thing, they know what they need to do, just doing it. And all the time it's the hard decision, either closing a loss early, holding a winning trade. Maybe you close your profits early when you know you shouldn't. It's hard. You're trying to get that instant gratification of a win. It's uncertain that the win will keep on going, and it's difficult. But you can also kind of adapt that to your psychology. I trade 1.5 risk to reward because I'd rather close a trade early and see it go into profit than see it reverse for me. And I'm a bit impatient. If you're targeting higher risk to rewards, you're accepting the pain of seeing it reverse, and I'm accepting the pain of closing early and seeing it go on without me. You can't avoid pain in trading, but you get to choose it, which is still pretty good. But yeah, do you have any kind of questions? Anything you want more information on? Yeah. And you can send me any questions you have throughout the week. Sorry about those mic issues that you're having, but send me any questions throughout the week. I can help you out. If you're not sure about technical analysis, any trades you took, send me screenshots why you took those trades. I can help you out, give you some feedback as well. Help you out as well. But just focus on having that plan, having that journal, tracking how you're going, and focusing on learning over winning, getting that internal reward, and try out that negative visualization in the prop firm because it can be difficult with that psychology as well. Yeah, thank you as well. So you get a lot out of executing on that skill, practicing by doing. I get a lot of teaching, so thank you for that as well. I look forward to hearing how you go in funding challenges. It's difficult, but best luck with that as well. I'll speak to you soon. All right. Thank you. See ya.